information and sessions like this where you can really explore such career opportunities. And as I said, that's the whole philosophy behind the Uday Knowledge sessions, where we specifically focus on different financial services and fintech concepts that we bring to you by industry experts and leaders from the industry who can provide their perspective not only on those concepts but also on the career opportunities and the skill sets you need to excel in that space. So I think that sets it up well to really welcome. And we're really excited to have him, Mr. Yatrik Vin, the CFO of NSE. As a lot of you already know, Yatrik has been associated with the NSE almost since its inception and has played a very pivotal role, a strong role in really establishing the brand and the institution that it really stands for today. He brings with him over 30 years of experience across a varied breadth of different sectors, be it corporate strategy and finance, M&A, treasury, and risk management. And also has a technology bent of mind in terms of leading such tech transformation. So we're really excited and honored to have him today take this session. As with previous sessions, we want this session to be interactive. And before I hand it over to Yatrik, I thought I'd just quickly cover some quick ground rules. Yatrik will be covering some core concepts related to personal finance and systematic savings, and will then address some of the questions that you have. There's some questions that we've already got at the time of registration, but we also would invite you to use the Q&A feature on the WebEx to be able to ask your questions. So if you're looking at your screen right now, it shows that if you're accessing the WebEx from a laptop, then you just need to click on that black button with the three dots and click on the Q&A option. The Q&A option will then open up a chat screen where you can specifically choose all panelists and then place your questions so that all of us can see it, and then we can pose your questions to Yatrik for him to answer. If you're accessing this from a phone, it's a similar flow. Again, choose the button with the three dots and choose the Q&A feature, and then choose all panelists so that we can see your question. Just one round of advice. What I suggest is listen into the conversation. I think Yatrik already has a sense of a lot of the questions that have come in, so he's going to be tailoring his conversation towards that. So some of your questions may already get answered, but do keep sending in. We'll keep pausing at different points during this this whole session to really answer as many questions as you have and cover this so that is most beneficial to you all. Right. So without much further ado, over to you, Yatrik, and welcome again. Thank you.
Thanks, Avnish, for that humbling introduction. At the outset, it's really a great honor and privilege to participate in this initiative of Uday, care of Government of Maharashtra on FinTech Hub Specialization. Indeed, it's a great pleasure to particularly address some of the younger crowd who are basically the engineering and MBA and other finance students, to help them understand some of the key concepts of investments and why it is so very important to start cultivating investment habit at a very early age of the career. So that way, really quite honored and happy to share my thoughts. Also, thanks to Abhilash and his team for organizing this such wonderful webinar, and I'm sure that it goes one step forward in the overall NSE's knowledge and financial literacy area, and I'm sure that it's one more milestone in the overall NSE journey. So before I start on, a small professional sort of declaration I would like to make, that whatever I'm going to speak for next 45 minutes followed by Q&A session are all my very individual and personal thoughts, and NSE may or may not subscribe to this thought process in that sense. So kindly consider it to be my very individual and personal thoughts. So before we start on with what it means to save the money and have the systematic investment habit, there are 2 or 3 important principles of building wealth. Because when we talk about investment, it's all ultimately boils down to how do you create wealth in your professional life. And therefore, those 3 principles essentially are, number 1, how much money actually you invest. The second important aspect is what is the rate of growth in your overall investment and the returns that you earn out of that investment. And thirdly, what is the time period for which you undertake this investment. Really, the entire wealth building exercise or sound investment revolves around these three important tenets of the investment making. Now, my entire discussion with all my young friends would be to two parts. In part one, I would lay down some of the core principles of how do we go about doing the funds allocation for investment purpose, means what we need to do to create sufficient corpus for investment purpose. And part two, I will try and devolve upon some of the important asset classes at this age of mid 20s or early 20s. One can look at going forward for next 20 years or 30 years or 40 years, which will actually help build the wealth in a very systematic and relatively less risky way. So the first part, when we talk about as to how do you go about creating the corpus for investment, first and foremost is that before you start investing the money, one must have the investment goal. Now that goal would largely depend upon what is your current level of income, how much you are earning today, because your ability to invest has substantial bearing on what are you earning today. The second part is what is your age profile? Right? The investment goal for a person in mid 20s could be very different than the person with mid 40s and could be very different with person with mid 60s or mid 70s who is actually superannuated. So the age profile of a person looking at creating investment strategy also is important when you determine the goal. If I am to slightly elaborate on this, is that an individual with mid 20s as the age group should largely look at something which is long term, should also largely look at some of the asset classes which are relatively slightly more risky than the pure zero risk kind of investment strategies. Why do I say that? It does not mean that you put your money into a very heavy and high risk areas, but the principle of finance, some of my finance colleagues, my finance student friends would agree that risk and reward in life always goes hand in hand. So if we are looking at some little step up reward, then it is important that we also have some sort of calculated, risk mitigated way of taking that extra risk. It only helps you generate that additional alpha, as we say, in the returns. Now, why in the entire investment philosophy, the returns becomes very important? Because the entire returns that you generate out of your investment eventually depends upon what is the inherent inflation within the economy. So say for example, if the inflation in the economy is at 7% or 8% at a very consumer level, and if your investments are earning say only 6%, that means every passing year you are destroying 2% of your wealth. Now here we are talking of building the wealth, and therefore in our wealth building exercise, as far as possible, our strategy should be such that my weighted average annual return on investment has to be something more than the average inflation within the economy. Then only you are building the wealth, otherwise you are destroying the value. So, therefore, the overall understanding of the investment objective becomes that much more necessary. The second important part of making some investments and creating that corpus for future wealth building is one has to live within his or her means. Now, when I say that one has to live within the means, does that mean somebody has to be very frugal? Does that mean somebody has to be very miser? No. Answer to that is not that one has to be miser, but if you look at it from a different standpoint, there is a difference between cost of living and cost of lifestyle. And if you observe last 3 months or 4 months, this COVID situation has taught us that while cost of living is not so high, cost of lifestyle definitely is. Another important, therefore, principle of creating that investable surplus is try to live within your means and do not unnecessarily spend money on lifestyles. Because many times you see that people spend extravagantly on a lifestyle, and at the end of it, they say that I don't have any money left to do any meaningful investment. Mind you, there is also a difference between having a wealth and appear to be wealthy. Most of the lifestyle kind of spendings, they tend to make you appear wealthy, but you may not be. And having wealth is a completely different paradigm, and having wealth is a big mental and social comfort for any individual. So, very important part that please live within your means. Now, one associated concept of living within the means that we have not to invest something which is left post my expenditure. But as I have read and I have observed people, if 100 rupees is my income, you first invest and then whatever is left that you spend. Most of us, what we do, whatever we earn, we first spend and then whatever is left out, and sometimes nothing left out, we try and call it as an investable surplus. That is not the right way of building the wealth. The another related principle or a concept or an idea is that one has to have speed in making investments, because many times we get lazy about our investments, many times we delay our investment decisions, but these are all very counterproductive kind of ideas. You have to be in utter hurry to start investing and building wealth. Now, how do you do that? One of the benchmark or one of the goal within your investment one should keep is that I have to reach something called as a tipping point. Under investment world, there is some concept of a tipping point. What is that tipping point? The tipping point essentially is that the income that I generate out of my investment corpus is more than the investment allocation I do month on month. Say, for example, you are earning 100 rupees out of your investment corpus each month, and you are setting aside 80 rupees or 90 rupees each month for so many years as an investment allocation, you have reached that tipping point. That means your investment corpus is self-sufficient for you to generate and build wealth on its own tomorrow, even if you do not allocate any additional rupee for your investment purpose. Try to achieve that tipping point as fast as possible in life. The third important part is, as I said, you have to start early. Now, most of you, you are into your early 20s or mid 20s, so you are absolutely in a right phase of your life and the career. Some of you are still students. Some of you, therefore, tomorrow, after 6 months, 1 year, you will go out and start looking out for jobs. Some of you may be employed also. Now, in whatever facet that you are right now, you have to start early for your investment. Now, I'll just give you one small example, mathematical example. Say, for example, there are two individuals, Mr. X and Mr. Y. Now, Mr. X is, say, 25 years young, someone like you, and Mr. Y is, say, of 35 years. So, there is a 10 years of age difference between these two individuals. Now, Mr. X every month allocates say 10,000 rupees for investments. So each month out of the total earning 10,000 rupees she or he goes out and invests. Same is Mr. Y. He also wants to have some investment corpus, but since he is better off in terms of his earnings, say Mr. Y goes and allocates say 20,000 rupees per month. Okay, both these persons, they want certain corpus at the age of 45. That means 25 years young person has 20 years of investment horizon, 35 years person has 10 years of investment horizon. Now, in this 20 years, person with 25 years age has invested 24 lakhs of rupees. Same 24 lakhs of rupees, Mr. Y also has invested because he was allocating 20,000 per month, 12 such months, so 2 lakh 40,000. For 10 years, 24 lakhs. You will not believe, though both X and Y have allocated same amount of 24 lakhs, both were earning, let us say, 15% return on investment. You will not believe, at the end of 45 years of age, for same 24 lakhs investment, Mr. X will get close to 1.5 crores, whereas Mr. Y will get just 50 lakhs. So wealth building is 3 times: A, when you start early; B, the power of compounding. Friends, understand that the power of compounding is so very high that we do not know, we do not realize, but how silently and systematically the wealth keeps building. In fact, some of you may know that Einstein had once said that power of compounding is like eighth wonder of this world. So do not be somewhat procrastinating in your investment decisions. Try and start early. You don't have to spend and you don't have to invest every time 1 lakh rupees and 2 lakhs rupees. Even 5,000 rupees, 10,000 rupees, small amounts on a systematic basis gives you a huge advantage when you go 20 years, 30 years ahead in your investment objective. The other important principle is savings and investments, as far as possible, have to be automatic. Now, many times we see people have money, but they procrastinate and do not invest. Many times investments are not systematic, they are not into equal quantums, and they are also not timely. So if you want to overcome all these pitfalls, then it is important that your savings and investment becomes automatic. Now here, how does it becomes automatic? All of you know, nowadays with digital banking, there are functionality facilities available for ECS, there are facilities available for SIPs, systematic investment plan. There are also facilities available for auto deduction. Now, why do this principle become so important? Number one, anything which is discretionary in our life, sometimes it works counterproductive. You have to treat your investment ruthlessly, rigorously, and something which is not your discretion. And therefore, I always advocate that your investments have to be automatic. Number two, more and more, the investment is automatic. You do not have any money left to spend it on things which otherwise you may not need or otherwise which are not desirable. Because unless you have the money, you're definitely not going to go out and spend that. And hence, our earlier principle of income minus investment should be the spending gets automatically fulfilled. The other important part, the fourth principle is you have to be, as I said, ruthless in your investments. Meaning thereby, please overcommit. Overcome it in the sense that if you have some X amount of your income, try to stretch as much as possible to increase the allocable surplus in your overall investment philosophy. Overstretching helps you, number one, creating a larger and larger corpus. Number two, it also saves you from unnecessary spendings. And number three, when you overstretch your investment surplus, you also find the necessity of increasing your income. Friends, you are all very young. One important part of building wealth is firstly you have to earn, then only you can save, and then only you can invest. So investment has very large bearing on how much you are earning. And if you earn sufficient amount of money, and if you try to be ruthless about your investment allocations, definitely it's very easy to build a wealth. The other aspect of investment principle is, as far as possible, you should keep all your investment assets out of your reach. Now, when I say it has to be out of your reach, in the sense, once you invest, you have to forget that you have invested this money. Do not get the temptation of liquidating those investments when not needed. That doesn't mean that you should never touch that. Suppose there is some medical emergency, of course you have to liquidate your investment. If there is some marriage in the family, of course you may need to liquidate your investment. But for your lifestyle purpose, but for your holidays purpose, but for your leisure and comfort purpose, do not liquidate your assets. Why do I say that? The reason being, every time you liquidate your assets or investment, you are breaking the cycle of compounding. And every time you break the cycle of compounding, your wealth building objective gets jeopardized. Many people, you will also observe, they withdraw their retirement money for today's requirement. No, you should not do that. If it's a retirement money, it is definitely long-term money. It is invested with a particular objective. It is invested and fetching you certain returns. Let that return get compounded so that when you superannuate, you have adequate funds available for your requirements. The another two ideas or concepts we should always keep in mind. Number one, you must have a home of your own. Never ever say that real estate has gone down and therefore renting the house is much cheaper than paying the EMIs of the loan. Understand one thing, that what you pay as an EMI for loan, you are correspondingly and back to back owning a capital asset. But whatever rent you are paying to the landlords is a revenue expenditure. It goes forever with nothing in return. It is better to pay higher EMI and buy a home of your own rather than paying rentals throughout the life, even though they are cheaper, and not have home of your own. Because having a home, having this good investment corpus are basic necessities and securities of life. So one must own the home. Our investment objective should start with, I want to own a home. Second one is, I want to then build a wealth. Okay. The another aspect is that you do not know what kind of medical emergencies that any of us, or practically all of us, or our family members, definitely we face those situations. Here are some one or two important ideas of building the wealth. Now, many times we observe that you keep doing a lot of investments, very systematic investment, you have certain corpus, but one or two sicknesses in the house and hospitalization and lakhs of rupees goes in that. With great difficulty, whatever corpus or the wealth that you would have built gets completely used up meeting those medical emergencies. So, if you want your investment objectives not to get affected by such kind of medical issues, you must have a medical claim policy. And that medical claim policy has to be sufficiently liberal considering the cost of medical treatment that is prevalent in the metro cities and in town A kind of cities in our country. So you must have a medical policy. What kind of medical policy you should have? You should have medical claim policy as a family floater, which covers yourself, your parents, your spouse, and your children. It has to be a family floater whereby same liberal limit in a financial year can be used by all of the family members or any of the family members up to a particular threshold. Now, why this is important? This is a natural hedge of your investment corpus. Till the time your medical requirements are getting taken care of by the insurance, your investment objectives do not get affected, as I said. The second important part is, since you are the earning member of the family, you have certain income, you have certain investment objective. God forbid, some exigency happens and your life is lost. Then in that case, that entire investment corpus has to be in the hands of the people who are actually surviving you. At the same time, they should then, that point onwards, should not be suffering because the person earning is no more there. And hence, future financial security is always in doubt. How do you cover that? You must take out what is called as term life insurance. What is this term life insurance? These are the life insurances which most of the good companies they offer, where the premium is very, very cheap. So if I say, for example, if you have to take a term life insurance of 1 crore rupees, the premium could be something around 15,000 or 17,000 rupees per annum. If you want to take 5 crore worth of insurance, the term life, it's a yearly premium of, say, for example, some 25,000 or 30,000 rupees. Now, this 30,000 rupees, consider it to be an investment and see that you cover yourself fully for your entire life, so that tomorrow something, God forbid, happens, your family members who survive you do not have any financial problems. Now, if these are some of the ways one has to look at the investment, look at the strategies of the investment, what are the kinds of products available in the market, or what are the kinds of asset classes in front of us for investment options? Before we go that, one important part is any investment has to pass through 3 core tests. The first test of investment is how safe is my investment. So safety is one of the important ingredient of our investment portfolio. The second important ingredient of our investment portfolio is liquidity. And the third part is the returns that it generates. I will just deal with each of these 3 things slightly into more detail. Now, since ours is a hard-earned, salary-driven largely kind of income, we definitely cannot, need not, and should not put our money into risky products and risky propositions. Because there is no need that higher the risk, higher the returns. So my investment objectives can be only achieved if I put my money at higher risk. No. Answer to build wealth is not taking more risk. In fact, it is to take minimum risk and longer systematic horizon for investment. So rarely people who take risk, you will find them wealthy. And people whom you find wealthy would be the most risk averse people in life. You must look at around in your family, in your social circle, and see that people who have built good amount of wealth, have they really taken risk? If you go and ask them, they will say, no, we are the most risk averse person, including Warren Buffett. Warren Buffett books, if you read, he says that to make money, one need not take the risk, one has to actually mitigate the risk as much as possible. So, first thing is, you must put your money into a very, very safe area. It is possible to build wealth even then. I will just elaborate it in some point in time. Second one, your money should be, right, liquid. Now, when I say money should be liquid means you should be able to get your money back, right, as and when you want. That does not mean that I have to get my money back. No. Only thing is you have to put the money in those asset classes which whenever you want money, right, you can just get your money at ease. So liquidity is very important. Now suppose, say for example, you buy a piece of land. Yeah, it could probably be a good investment. But if 100% of your wealth, you just keep on acquiring piece of land, it is very illiquid. Tomorrow morning, suppose you want 10 lakhs of rupees, you won't be able to sell your land and get that money, right? Or if you keep buying too much of real estate, disproportionate to your total corpus, if you start buying too much of real estate, yes, in some pockets it might give you some returns, but it does not have liquidity. It may be safe because you have a property in your hands. So liquidity is very important. And third one is the returns or the yield. Now, when we talk about the returns on the portfolio, one has to also keep in mind that our returns on investment or on the portfolio is subject to tax. So every time when you compare the returns that you earn from an asset class A and the returns that you get from asset class B and returns that you get from asset class C, you have to compare the after tax or post tax returns. Now, why do I say that? Because today you may be into a age group and an income group whereby you may face maybe 10% or 15% tax rate. But after 15-20 years, I am sure you all will be at the peak rate of income tax, which is today in our country is at 37%. So if 37% of your income is going to just go away as a tax, then you have to compare balance 63 rupee from investment asset class A to B to C. Why do I say that? Because different asset classes have different taxation impact. The tax that you pay on interest on fixed deposit is not the tax you will pay when you will invest in funds, is not the same tax that you will pay when you will buy and sell, say, a piece of land or a flat. The taxation levels, tax rates are very different. So which asset class to select also depends upon the returns, and the returns always therefore has to be after tax, post tax returns. The another important part when I talked about safety. Now, how do I know that a particular investment is safe or not? So there are three areas of risk that impacts the overall investment journey. The first risk is credit risk. The second one is the interest rate or the market risk. And the third one is the liquidity risk. Now, what happens is that every time you make an investment, the asset class or the entity with which you are placing your money could be subject to credit risk. That means entity just vanishes away, or the entity's credit worthiness goes down so much that that entity is not able to service your capital allocation, the money that you have invested. You stop getting the returns, the dividend and the interest, and or many times you end up losing your principal amount also. So when you look at safety, you have to see the entity where I am putting the money, is it safe and credit worthy? Right? That is credit risk. The second risk, as I said, is the market risk, or what we call it to be the interest rate risks. Now, suppose you go into some bonds. Right? Now, interest rates suddenly changes. Either it goes up or either it goes down. So if interest rate goes down, then you will start earning less income. If interest rate goes up, the value of your bond comes down. So either you end up compromising the income on that bond, or at times you will end up sacrificing the principal investment amount itself, depending upon whether interest rates are going down or interest rates are going up. So this kind of interest rate or market risk also impacts our investment portfolio. And the third one, as I already elaborated, is the liquidity risk. Something which you can't liquidate really cannot give you the money anytime that you want, and therefore do not allocate over heavy funds to the place which is not so liquid within your investment portfolio. The second part of the strategy is that never, I would individually never therefore advocate to use insurance products other than the term life insurance that I explained to you, which you should and you must take. Mediclaim you should and you must take. But many people take very large scale insurance policies. Now, on the insurance policies, if you look at the annual accruals and the premium that you pay and the maturity amount that you get in a endowed policy, the returns are close to 3.5–4%, which is nothing but equal to savings bank account interest. Friends, insurance is not an investment product. Insurance is a risk hedging product. It has to be dealt with in its own way, in its own scale, and in its own appropriate way. But it cannot become your investment product. So if you say, I will pay every year 5 lakh rupees as insurance premium and I will take 10 crore or 15 crore of cover, it's a very, very bad idea of dealing with money. Right? The third part is people use gold, silver as an investment class. I would say, yes, it is an investment product. It is an asset class. But number one, the year-on-year returns of gold and silver hasn't been so high. Our recent experiences of last 3 months and 6 months and 1 year of gold prices moving up from 30,000 or to now 50,000, etc., are unnatural conditions in which gold is behaving. That does not mean that this pace of growth in the prices of gold will continue for next 20 years. No. Not more than 10 to 15% of your total target wealth amount should be in gold. So if your target wealth amount is say 100 rupees, when I am at age of 45, I need to build 100 rupees of my entire wealth corpus. Not more than 10 to 15 rupees should be in form of gold and silver. Remaining 85 rupees should be non-bullion kind of assets. The next asset class which I would like to deal with and just explain to you in a simple words is about fixed deposits and mutual funds, which are pure debt mutual funds. Now, as the interest rates goes down, right, because definitely our government is working out their monetary policies in a fashion that they want inflation to remain under control. And if inflation has to remain under control, obviously they keep changing the interest rates. Now, if interest rates keeps going down, and as currently they stand, interest rates on bank fixed deposits of very good banks, right, both public sector and private sector, some top 3 or top 5 banks of the country, the rate of interest are post-tax 5%, 5.5%. Now, friends, the inflation at consumer level that you and me we are experiencing every day for our day-to-day items of consumption is nowhere below 7 to 8%. And if the bank deposit gives me 5% and 5.5%, means there is a gap of easily 2 percentage points. The money that I keep in fixed deposit is like therefore melting ice. Every passing year, the ice will keep melting, and at some point, you will have your principal amount so very less value, you will not have any meaningful wealth building. Fixed deposits, I would not encourage, especially people with your age group, early 20s and mid 20s, to look at. It could be good for a person who is superannuated. It could be good who has only next 10-15 years of horizon for earning the interest and income. It could be good if you have a large corpus. Say for example, if an individual has 1 crore rupees of corpus or 5 crore rupees of corpus, and within that, suppose you have 20-30 lakhs of FD or 50 lakhs of FD in 5 crore, it is okay. But not 80% or 100% of the money in the fixed deposits. Okay. Now, if at all we want to allocate something to bank fixed deposits, then I would strongly suggest from tax arbitrage standpoint to go and invest into debt mutual funds. Right? Most of the mutual funds or rather all the mutual funds in our countries, they offer pure debt mutual fund schemes. And I think there are some 700-800 odd mutual fund schemes available today in our country. Now, why do I say that? Okay, of course, those debt mutual funds have to be of those schemes where the underlying portfolio has to be of a top class. And when I say top class means the underlying portfolio of those schemes have to be strictly AAA, A1 plus kind of rating by rating agencies. AAA is the highest rating today in our country any company issuing the bonds can get. So select some schemes which are AAA, A1 plus rated paper driven schemes and invest in those. Also, another important tenet, do not invest into 15 or 20 different schemes because you lose a track on it. Sometimes keeping track of investment also may not be today, but after 20 years you will realize that keeping track of investment itself is a task. One should not unnecessarily spend energies tracking 50 different investment line items. You should have at the most 20 line items in all totally, right? So that you are able to have a concentrated and focused attention to how your investment is actually moving, right? So here is the comparison between fixed deposits and the top quality debt mutual fund schemes. So if you invest 1 lakh rupees in a bank fixed deposit of some very top class bank, private sector or public sector, And same 1 lakh rupees you invest into debt mutual fund. Okay? You invest this money, say for example, for 3 years. 1 lakh rupees with a investment horizon of 3 years. It's a one shot investment. And suppose both this FD as well as debt mutual fund scheme, say theoretically earns 7% interest or returns. So in 3 years, you will get 22,500 rupees, right, as interest on FD, same 22,500 as interest on debt mutual fund schemes. Because first year you will get 7,000, then on 1 lakh 7,000 you will get another 7%, 7% at a compounding level. So you will earn 22,500 gross before tax under both. Now look at the taxation part of it. Now whatever 22,500 interest we have earned on fixed deposit, you are at say 30% tax rate. So straight away 30% of 22,500, which is 6,750 rupees, gets knocked off as tax payment. In hand therefore is 15,750 rupees. Your return therefore is 15,750 over 1 lakh rupees of initial investment. It is 15% or rather 15.75% to be precise. Over 3 years, 15% is annualized 5% each year. This is fixed deposit scenario. Come to the mutual fund scenario. 1 lakh rupees invested at 7% continuously for 3 years, 22,500 is your total income. Now, under Income Tax Act, there are two things. One is the dividend that you get on debt mutual fund has taxation rate of 20%, not what you are at. So if you are at 30%, it will be 20%. If you are at 20%, it will be at 20%. Secondly, there is something called as indexation benefit. Means your 1 lakh rupees of original cost is allowed to be indexed up, right, with reference to one inflation table under long-term capital gains under Income Tax Act. So if you refer to the latest table of our Income Tax Act of the current financial year, then the index cost of that 1 lakh rupees after 3 years will become something which is close to 1 lakh and 15,000. So your 1 lakh becomes 1,15,750. The tax that you pay therefore will be only on 22,500 was your income minus 15,000. You will pay tax only on 6,000 rupees because your 1 lakh is allowed to be jacked up or indexed up by another 15,000 rupees. So your gain is only 6,000. In fixed deposit, you pay tax on entire 22,500. Secondly, on fixed deposit, you pay tax at 30%. In debt mutual fund, you pay tax only at 20%. As a result, your tax outflow would be just 1,300 rupees. And in-hand income is close to 21,000 rupees. And 21,000 over 1 lakh gives you 6.5% annualized return. FD was giving you 5%. Mutual fund gives you 6.5%. So clearly, you earn 1.5% every year more by investing into debt mutual fund. Very important asset class for people of your age and context to consider. Another important, very useful asset class, which you must do it along with your insurance, family floater, medical insurance and term life, is PPF, Public Provident Fund. If you have not opened it thus far, please open one PPF account with any of the nationalized bank. Now, what is the advantage? Number one, whatever deposit that you make in a year under public provident fund earns you at current level 7.1%. Once upon a time, it used to be 9%. Then when I was of your age, very young, it used to be 9.25%. Then it came down to 9%. Then it came down to 8.5%. So gradually there is a reduction. In current financial year, it is 7.1%. Now, most important part is this 7.1% that you get is fully tax free. You pay zero tax on this 7.1%. Now, what happens? Suppose somebody is at 30% tax bracket. Then, in that case, 7.1% in hand tax free is as good as before tax 10.6%. 10.5%, and this is with nationalized bank. This money is with government. Number three, nobody can touch this money even if, God forbid, you are convicted of an offense by any court of law in the country. Nobody can touch this PPF money. People can take away all your wealth, including your land, building, bullion, housing, fixed deposits, mutual fund, everything. PPF cannot be touched. So you get 7% tax free, 10.5% before tax if you are at 30% tax bracket, and it is very, very safe. Only thing is, because it is such a very attractive piece of investment, you can't invest 10 lakhs rupees every year. There is an upper cap of 1,50,000 rupees that you can invest in 1 year. And once you open a PPF account, you have to keep it live for 15 years at least. So there is a block of 15 years as a first block. There is no compulsion that you have to put 1.5 lakhs. No. So particular year you can even put 500 rupees. There is no limit, minimum limit, but there is an upper limit of 1,50,000. But strong recommendation, you must invest, put your money into PPF account. Even before mutual fund, I would recommend PPF. The another important asset class for you people, important, and please ponder over this, is equity as an asset class. Right? It is generally said that whatever be your age, 100 minus your age should be the percentage allocation to equity provided you have home of your own. I repeat, whatever be your age, 100 minus your age should be the percentage allocation to equity in your portfolio provided you have home of your own. I am stressing home of your own so much because India has still not become America or Canada or Europe. There, having a home, not having a home is all one and same, because real estate there, the land is so vast, real estate is so cheap, and people do not have any incentive, motivation to invest or not invest in homes. We are all India-based people. And for us, the size of the land is limited. We are a heavily populated country. Real estate can never go out of flavor when you say 30 years from today. People say real estate has lost its life, it has lost its charm. But 30 years from today, also when you are going to be working professionals in metro cities, Mumbai, Delhi, Chennai, Calcutta, Hyderabad, Calcutta, etc., these places, real estate has not lost its charm ever. So, once you have your home, if you are in the age group of say 30, people recommend 70% of your corpus should be in equity. Why? Because equity in long run gives you highest returns compared to gold, silver, fixed deposit, PPF, debt mutual fund. All those asset classes on one side and equity is completely on the other side. There is one statistics, I will just share it with you. Last 20 years, so 2000 to 2020, I did the study. Equity gave us year on year 13% return. Last 10 years, equity has given us 17% returns. Last 5 years, it has given 12% returns. So 20 years, 10 years, 5 years, 13%, 17%, 12%. Vis-a-vis this, bank fixed deposit rates have last 20 years, bank fixed deposit returns have been 6.5%, 5.5%, and today close to 5%. Gold last 20 years has given only 11% return. Last 10 years, 8% return. Last 5 years, it has given 9% returns. And real estate, India average real estate, 20 years it has given 8%, 10 years 13%, and last 5 years only 5%. So, if you compare, equity always gives you, right, something definitely more, at least 4 to 5% more than the normal rate of interest. So if the normal rate of interest is say 6%, you will get 10% or 11%. If normal rate of interest is say 8%, you will get 13-14%. Now within equity also, there are multiple ways in which you can invest in equity. One is you just go and buy some good company shares. That is the first way you can buy equity. Second one is you go and invest into some equity mutual funds, schemes. Like debt mutual fund, you invest into equity mutual fund. And the third one is you go and buy into exchange traded funds, ETFs. If you very individually personally ask me, I would suggest only ETF, nothing else. Now, why do I say so? Not because other options of equity investments are not good, or not because they do not earn you any returns, etc. No, I am not saying from that angle. Number one, if you invest into an individual company stocks, you have to research that company well. Then you have to track that company. Then you have to understand the ups and downs in the business cycle and the industry cycle in which that company is. And you have to therefore live with volatility of returns on your investment. Now remember our original principle, safety, liquidity, and returns. Any form of equity will give you huge liquidity, whether it is stock or it is ETF or it is debt mutual fund, you get your money in 24 hours. So liquidity is all equal. Then comes safety and returns. Now what happens is, if you buy 100 rupees worth of shares of company A, you have to take a call on that company, that industry. Suppose it's a pharma company. So you have to research how the pharma company is, what are the competitions, where my company vis-a-vis those 20 other pharma companies stands, whether my pharma company is a specialized drug manufacturing company or it's a general drug manufacturing company. Is it having a local flavor or it's a multinational? Then is this company is only into a particular product line? Because many companies you would have read only specialize in oncology, that is cancer drugs. Some company they specialize only in dermatology, that is skin related disease. That is how they do the research and that is how they come out with the product lines. That means you are taking a very focused decision to invest 100 rupees into a company which is into a particular field and has this much of industry play. It may be a very good investment, it may not turn out to be a good investment. The fact is how much of effort and struggle you are making to take that call. if you are really taking an informed call. And after taking all these informed calls and struggles, there is no guarantee that your decision may go right. Right? So, in that case, the next option. Next option is, then I go and invest into some equity mutual fund. Now, 100 rupees if I put into some good mutual fund scheme, today when I am investing, that scheme is investing into certain companies with certain sector exposures, with certain business cycles. But these mutual fund portfolios are always subject to churning. The fund manager in that mutual fund scheme will keep churning the portfolio to generate extra returns. Now, 5 times you churn the portfolio, you keep buying, selling, you sell X, you buy Y, you buy A, you sell X. You keep doing this crisscross. 5 times the fund manager may turn out to be very efficient, but he is also end of the day a human being. He may also make 1 or 2 mistakes and suddenly returns will come down. Whatever you earned in last 3 years can come down by 30-40% if 1 or 2 large decision of that fund manager goes wrong, because even he is a human being and he also depends on some analysis and he also takes some calls. My very personal individual choice, strong recommendation, but not the only recommendation, is buy ETFs. Now, what is these ETFs? These ETFs are nothing but they mirror the lead indices of the exchange. Right? Now, since I am from NSE, please pardon my saying, but NSE's index Nifty. So we have a Nifty-based ETFs available in the market. Right? We also have Sensex-based, which is BSE-led Sensex-based ETF available in the market. Now, what these fund houses they do is, suppose you give him 100 rupees today. So say for example, today the Nifty level is say 10,800, as I just saw some half an hour back. So today suppose Nifty level is 10,800. Today you give him 100 rupees. So in your name, he will buy 100 rupees worth of ETF. ETF, you have to assume it to be a unit. It's like a paper unit. So he will buy n number of units for you out of that 100 rupees. When Nifty is at 10,800. Now every time Nifty becomes 10,900, right? It has gone up by 100 points. So Nifty has improved, right, by say for example 1%. So when Nifty has improved by 1%, right, your portfolio 100 rupees will become 101. Reverse is also true. Suppose Nifty becomes 10,500. So Nifty corrected by 300. 300 over 10,000. So Nifty has corrected say 3%. Your 100 will become 97. But it is proven by statistics, and you can check on the Google, you can check on any of the website. In long run, with a time horizon of 7 to 10 years, ETFs in our country have generated a return which is 3 to 4% more than any actively managed mutual fund, equity mutual fund schemes. And what you have to do, you have to only give 100 rupees to that fund house, automatically that ETF gets bought and comes into your demat account. And you can create an SIP. So every day, every month, on a specific day, money will keep going. So suppose say for example, you want to put 100 rupees a month, right? There are 30 days, 20 market days. That means 5 rupees every day. You give standing instruction to your bank, 5 rupees will get debited to your account, ETF will get purchased through your broker. End of the day, those ETFs will come into your demat account. Once you give the mandate, it remains for your lifetime. It is a very systematic, very this is disciplined way of doing investment. Now, what is the advantage of ETF? Why it generates more returns? This Nifty ETF or Sensex ETF, for example, actually mirrors our Nifty movement. And what is Nifty? Nifty is top 50 blue chip companies of our country, which actually determines our country, our markets, our economy and performance of best companies, which includes companies of all Tata Group, Birla Group, it also includes all MNCs, it also includes any banks from all the good PSU banks and private sector banks are top 50 companies. If these companies perform, markets will be good, Nifty will be high, your portfolio will earn the income. Here you are not taking any company call, you are not taking any sector call, you are not taking any industry call, because these 50 companies, they represent 23 sectors of our country, and no individual company has more than 2 or 3% weightage in the entire Nifty. So when 100 rupees ETF you will invest, you will put 2 rupees in Infosys, 3 rupees in TCS, 1 rupee in some pharma company, 50 paise in some other company, like that. Your portfolio is so diversified, it has a natural risk hedging included in it. You will always build wealth in a very systematic way. So my very individual liking, choice and a strong suggestion is ETF. However, if you are good at reading balance sheets and taking sector calls, you can buy direct stocks also. But equity is always at your age group better than any other asset class after you have mediclaim, after you have home of your own. This is, in summary, are few of my ideas I wanted to share today.
Thank you so much. I think there's been a phenomenal session. We've had some very strong participation as well. What I'll do is I'll try and club a few key themes that I'm seeing across different questions. And then maybe we can focus on also the career aspects. I think in the interest of time, I'll maybe come with a few questions to begin with.
Sure.
I think one common theme that I've seen, sir, and I think you've covered this to quite a large extent in your conversation with the students, but just to reiterate it again, is the whole risk-reward concept and trade-off. And being aware of what rewards there are through the different strategies you can look at, but also how do you balance that with the different risks that you mentioned. The questions are on how do you, so that I'll give you a sense of the different questions that have been asked. Some people have asked, how do you manage risks in a more systematic fashion? Some people have talked about, when I'm looking at investment options, how do I really understand what risks I'm getting into? Are there any sources of information I can look at to really further understand this in key detail? But how do I balance that trade-off is a core question that some of the students have asked.
Yeah. Okay. So just to respond to those questions surrounding risk reward and how do I measure the risk, etc. The first principle may sound very simple as an answer, but yes, believe me, it's very true. The best way is not to venture out, take heavy risk when it comes to your hard-earned money getting invested. I gave some example that even Warren Buffett strongly advises not to take risk to make money. You have to, in fact, mitigate the risk. Having said that, right, the way to mitigate or to take care of the risk is you have to ensure that at no point in time you are taking any credit risk, in the sense that do not put your money where you are doubting the investee company or investee asset class or investee paper, right? Because credit risk leads to eroding your principal amount. One can live with market or interest rate risk, because at the most what you are losing is your income but not the principal amount. And number three, you can take liquidity risk, because if you are invested somewhere, it may be difficult for you to get out. but it never becomes impossible that you can never get out. There could be time delays. And if there are time delays, there is a temporary source of financing available where you can put your existing asset as a collateral and raise the money. But the day you start taking credit risk, you are risking your principal amount. As a result, not to take credit risk means only invest into top rated companies and top rated papers. Top rated, I insist, nothing below triple A. There are some good companies, some papers who have never defaulted, but they are double A plus. Mind you, between double A plus and triple A also, there is a shared difference. And when it comes to long-term wealth building, never put money other than triple A or A1 plus paper. You have to deal with top class investment instruments. Balancing between risk and reward, therefore, is reward has not to be looked from risk standpoint, but reward has to be looked at from what is my inherent inflation in the economy. Till the time you are earning, right, some 3 or 4% above inflation, you are definitely building wealth. Sometimes you may build wealth faster, sometimes you may build wealth slower, depending upon whether you are 2 percentage point above inflation or you are 4 percentage point above inflation. But reward has to be looked at from inflation standpoint, not by taking risk. And third one is, longer you go, longer the duration of your investment strategy, safer you go, and more passive you go, you end up making more money. More actively you try to manage your investment, you start losing it. That's why they say that it is not the intelligent people who make money. It is actually the people who are disciplined and not so actively managing the portfolios, they make the money. Because when you start managing anything actively, you do 5 good things and 2 mistakes. But those 2 mistakes take away all the good things of 5 times that you did it. So the best way to avoid mistakes is not to venture out so much, remain passive but disciplined in your investment approach, having chosen the right avenue once. That is my response to this.
Thank you so much. I think a related question is around. So while this session has been very informative, and I think the fact that we still have very strong participation really reflects that. There's a common question around where can students really get more information? How do they build capabilities in this space? What are the sources of information they can look at to really master this to a high degree and really establish their capabilities here?
Yeah. So all this, of course, there are huge amount of research available on the websites, but I would suggest websites which are of credit rating agencies like CRISIL, CARE, those credit rating agencies. They have very good research papers. Some of the mutual fund sites also, right, like HDFC's, Kotak Mahindra, ICICI, SBI mutual fund, they also have a lot of research about various companies. Of course, the companies which are there in their portfolio. So if you want to look at company specific, you can look at the credit rating websites or mutual fund websites. If you want to learn generally about how do I manage my investments, then there are Investopedia and various other investment websites also, which essentially tutors of investment strategies. There is also a very good website and lot of data available on Bloomberg website. So I think any of these websites, if you go through, I think you get sufficient material to learn about this and different asset classes.
Thank you. Thank you for that. I'm going to switch to the other side of the conversation, which we usually go into, which is around careers and skill sets. In fact, somebody has also asked a question around what do they need to do if they want to explore a career with NSE, or explore a career in this investment wealth advisory space, in the stock market space? What are the kind of skill sets that people need, and what are the kind of opportunities there are in this space?
Okay. So, point number one is the pure finance days as they existed probably at my time or maybe 10 years back are largely going away. There is nothing like pure finance, uh, but it is now all fintech because finance function itself has become highly technology driven and a lot of analytics and a lot of machine learning based finance it is now. So it is important that having taken the right conceptual training and clarity of finance, one must combo it with technology learning also. Technology, I'm not saying the purest form of technology, but the applied technology to the finance function. So it's, as very rightly aptly it is said now, is it's a fintech. Secondly is therefore in terms of skill sets, four things very important, especially this student fraternity whom I'm actually right now addressing to, huge amount of conceptual clarity. Because my very corner of the eye observation and since I also used to be in this teaching line for more than 2 decades, as I know for sure that this generation has a lot of information and it is good that they have a lot of data information, but ability to uh, distill that data and draw learnings and concepts out of it is actually slowly coming down. So please focus on what each data, each report is trying to tell us. What are the practical implications of those data, analytics, and reports? It's not merely reading the analytics and the report, but also trying to understand with the practical, correlated with the practical situation. The third thing is in terms of career, yes, finance always has been our most favorite careers of everybody, and not now, but even 30 years back also, people after out of IITs and IIMs will come and start working in finance department and give competition to hardcore chartered accountants in the country. So that has not actually gone away anywhere. Finance is a very growing this thing field. It's also a very highly paid field also compared to other sectors in the economy. But at the same time, it's also very rapidly changing and it has its own pace. One has to be therefore very fast and very adaptive and flexible in terms of learning the ever changing context in which the market behaves, the way institutions they this thing, the regulations that they evolve. So one has to be constantly learning, and I think one has to remain student for the life. Right? You cannot say that now, okay, 25 years, my education is over. No, I think at the age of 65 also or 55 also, people have to keep learning and reading. The readers are leaders. So that's what my take is. But skill sets, technology skill sets, deep intellectual analysis of everything that you do, and of course, ability to implement in right context.
Thank you so much. No, I think, and in fact, I think you answered my next question as well, which is around. There's always a debate around what is the level of technical skills that students need versus functional skills, and I think you hit the nail that it is going to be a combination of that and constantly keeping up to date with the latest concepts and functional understandings that will really differentiate students in this space.
Yes.
Yeah. So thank you so much. I think I'll take this opportunity to thank you again. I think it was a really refreshing and interesting conversation. I think we were really thrilled, first of all, in terms of the participation we got and the sustained participation and the kind of questions we got. A lot of the questions that were asked were, in fact, covered during your session. So I didn't really have to ask a lot of them. But even then, I think the insights and the point of view which you otherwise would not get from theoretical courses, something that students really gain from this. So thank you for taking your time also today.
Avnish, I just wanted to respond to one question. I saw somewhere on the screen flashing. What is my view on gold ETF? There was one question around gold ETF. while I did speak about equity, Nifty ETF, etc. So just a very quick response to that question is that ultimately ETF draws its value accretion from the underlying. So in Nifty ETF, it draws its value based on Nifty movement. Gold ETF will draw its value based on how gold prices move. And as I already responded or covered in earlier part of my discussion, that gold in last 20 years or so has given single digit 7-8% of returns, and in last 5 years also it has given some 9% returns. So if the gold is prices are not moving up, rarely you will find gold ETF prices moving up. So I would not. So between the two, I would recommend equity ETF and not gold ETF.
Thank you, sir. Thank you so much.
Yeah. Okay. Any other question? There is something on GSEC also. I saw just now somebody is posing question on GSEC. So quick answer to that. A GSEC is definitely a sovereign government guaranteed top class product, but the yields are very poor. They are just 6% and 5.95 and 5.75. When the inflation is at 7-8% at consumer level, right? You are actually, it's very similar to fixed deposits. It's a melting ice. So at this age profile of the students, they should not look at GSEC. It is more of a corporate product, not an individual retail product.
Perfect. Perfect. I think there's one last question if I can also talk about it. Somebody's asked, what is your take on green bonds? Does it have scope as renewables?
It definitely has a scope, but in India, still it has its own time to actually develop. Because first, really, India and India corporate has to become green. Then the green bond will start earning any yield. So it's too so-called exotic investment product for us. There are better, simpler avenues. We should stick to those.
Perfect. Well, thank you. I think those are some of the specific questions. There are a few more, but unfortunately, I think we've come to a stage where we'll have to probably close the session now. It's phenomenal. I think that the questions are still coming. So it's really fantastic to see the enthusiasm of the students. But yeah, just once again, want to thank you, sir, for taking your time out to take this session and really assist the students in understanding the core concepts that are around personal finance and investments. Thank you, Abhilash, as well, for joining in. Yeah.
It's my pleasure. Thank you so much for inviting me.
Well,
thank you so much for your time. I wish I had met you 25 years back. I could have got a little more wiser and wealthier. But thank you so much for sharing your life experiences and your wisdom around personal finance. Thank you, Avnish, for this opportunity. Look forward to collaborating more with that. Thank you so much once again.
Absolutely. Thank you so much for joining in. And to the students,
thank you to all the participants.
Thank you. Yeah, thank you from us as well for really participating and really making this an interactive session. As we said in the past, really look forward to hearing your feedback on the session. Any questions you may have, if you have any specific questions, we can always pass them on again to Yatrik and Abhilash. And also, we'd love to hear from you in terms of this format, any other topics you want to hear. So please do write into us at admin@categoryeducation.com. But otherwise, for today, thank you all and looking forward to the next session. Stay safe. Bye-bye.
Thank you.
Yeah.